be advised that this recorded webinar has been edited from its original format, which may have included a product demo. To set up a live demo or to request more information, please complete the form to the right. Or if you are currently not on CSE Global, there is a link to the website in the description of this video. Thank you.
Hello, everyone, and welcome to today's webinar, Fast Track to Reaching European Investors Through Our One-Stop Shop Solution. My name is Delphine Jones. I'm the Managing Director of Client Solutions for CSE US Fund Solutions, and I will be your moderator. Joining me today is Johannes Orig, the head of AIFM in Luxembourg, and Joe Flannery, the head of Depository in Ireland. Why don't we move on to Johannes? Why don't you share with us your perspective on why Europe is an attractive place for private fund managers?
Yeah, thank you, Delphine. Good afternoon, everyone. So I think it's a very interesting question, and I think both is reflecting also from a Luxembourg perspective why it's quite an attractive place. It's not only the question of having a large and diverse market, but also that Luxembourg is offering a very stable framework requirement, which is necessarily required for the investor protection. So just to give you also some background and some figures to manifest the first answer. So Luxembourg is, beside the US, the largest market for funds business. So it has a very robust environment, be it from an economic perspective, but also established an infrastructure of legal, tax, and financial professionals in Luxembourg just to assist the clients from multiple jurisdictions to set up their alternative investment funds or their funds in general. So in Luxembourg, just to give you also an actual figure based on 31st of January 23, we have a net asset Luxembourg investment funds over 5,600 billion US dollar. So this is manifesting the market and the market size we have out of Luxembourg, because also Luxembourg is the hub for distribution into the EU and EEA countries. Globally, alternative investment funds are rapidly increasing and growing. So these includes also strategies like private equity, real estate, debt, infrastructure, and other funds. So altogether, Luxembourg as a market is offering a good place, starting point for starting distribution and setting up the funds into the EU.
Okay. And Joe, your perspective?
Yeah, good morning, afternoon, everyone. I think before I try and answer the question, I'll just look at the size of the market again. So, I mean, it is enormous. It is the second largest asset management region after the US, with $23 trillion domiciled here as of last year. 7 trillion of that, over nearly a quarter of that, is in alternative investment funds. So, clearly a massive market, very well established jurisdiction as well for non-EU managers, such as Asian and US managers. So clearly a big market. In terms of the type of private funds that are here, I mean, it's obviously a mixture. Private debt funds would be the most significant market for private fund managers. But obviously there's a large proportion of private equity funds in Europe, and also, of course, real estate funds. Just to go back to the actual original question, I mean, why is it an attractive marketplace? Well, it's, as Johannes mentioned, it's a very stable political climate. You've got a very skilled, advanced workforce, skilled professionals, and of course, excellent infrastructure. I think more importantly, though, you have a very well-developed legal and regulatory framework under the Alternative Investment Fund Managers Directive, also known as AIFMD. This has created a harmonized regulatory environment for fund managers, making it very easy for them to operate across multiple jurisdictions. Also worth mentioning, it's obviously a very mature market with 40 years of servicing funds here within a harmonized regulatory environment within the EU. So that's obviously worth mentioning. And then just a little bit closer to home, I mean, Ireland is a fund domiciles collectively nearly around $1 trillion in alternative funds. So again, a big market and key jurisdiction for private assets. So, you know, when you look at Ireland and Luxembourg, they're, you know, significant players in this arena. Having said all that, Europe still does have a perception of being quite a complicated market to operate in, being very regulated, and you know, for some quite expensive. So, you know, we can go through this later, but I think for that reason, it's critical to, you know, having, you know, service providers who understand the environment, the regulatory environment, and how to comply with the regulations.
Okay, great. So for Johannes, what are the various Lux legal structures for private assets?
Yeah, also I want to pick up that what Joe just said. I think it's very important in the world of alternative investment funds to have innovative financial products. And this is reflected in the Luxembourg legal framework. Here we have to differentiate alternative investment funds that are regulated by the local financial supervisory authority called CSSF. Here we are calling mutual funds, which are still under the mutual fund law. They are predominantly for distribution and investors that are natural persons, but also institutional persons, but they are heavily supervised by the regulator. The same is applicable to the so-called specialized investment fund. We have here a specific legal regime for it. It's the law of 27. And the next level of regulated vehicle is the so-called SICAR. SICAR is a fund that is investing in risk capital, and this builds another type of a regulated entity. Last but not least, we have the LTIF. The LTIF is the European Long-Term Investment Fund regulation. Also, an LTIF fund is subject to the supervision of the local CSSF. Then we are coming to the unregulated alternative investment funds. That means that only the AFMs, or the alternative investment fund manager, itself is regulated by the financial authority and supervised, but the product per se not. And here the most prominent product we have in Luxembourg is the so-called Reserved Alternative Investment Fund, in short, RIFE. The RIFE has a specific regime. It's very popular in the meantime, since it has been created with a legal framework in 2016. And then last but not least, we have all other non-regulated, non-supervised alternative investment funds that could be set up in different legal types, be it as a capital company or as a limited partnership.
Okay. And Joe, what about in Ireland?
Yeah, I mean, in Ireland, there are several. For the purposes of today, I'm just going to talk about two of them because I deem them to be the most appropriate for private assets. So, namely, that would be the Irish Collective Asset Management Vehicle, the ICAV, and the Investment Limited Partnership, the ILP. So, you know, both are appropriate vehicles for private assets due to their flexibility and efficient structures. They're both tax efficient, and more tax efficient than other traditional fund structures, particularly when I look at compare them to others in Ireland. Another advantage is both can be structured with a high degree of flexibility and customization. Again, very important for private funds. You know, overall, both of them have become very popular, particularly the ICAV. The ICAV established here in 2015. The ILP has been updated more recently, but has also enjoyed a lot of popularity recently. So we've seen a lot of private assets funds using that structure the last year or two. I suppose the main difference between the two of them is their legal structure. The ICAV is a corporate structure, so it's a separate legal entity from its investors. It can own its assets, enter into contracts, etc. So that provides a certain amount of legal certainty there, protection for investors. The ILP is a partnership structure, so it doesn't have a legal personality as such, and is separate from its partners. But, you know, as mentioned, both structures are, you know, seen to be as modern, progressive structures, you know, high level of investment protection and transparency. So both are very appealing to private asset managers, which, you know, where complexity and liquidity of the assets can create additional risks. These are important factors.
Okay, Great, thank you. What is the market landscape like in Ireland and Luxembourg, and what are the current trends? So, Joe, why don't we start with you on that question?
Yeah, sure, Duffy. I think there's kind of four trends here I'd like to talk about. It's the continued growth, the Irish fund industry, technological innovations, increased consolidation activity at the service provider level, and then an increased regulatory environment overall. So, I mean, the first one, continued growth. We've seen massive growth in Ireland over the past couple of years. So we surpassed 4 trillion in assets under administration here last year. But that's driven in part by increased demand for alternative investment funds, including private funds. I suppose not unlike a lot of other jurisdictions, technological innovation. So we've seen huge advancements in the blockchain for custody and settlement, artificial intelligence to help us with our overall operating model and efficiencies, cloud-based platforms being incorporated into fund management processes, but also improving efficiency, transparency, and accuracy. So, yeah, you're seeing technology playing a key role. And I think, you're seeing within the Irish fund industry a high level of automation. I think there's an automation close to 96% here. So, that's leading to greater efficiencies across the board. I also mentioned that increased merger and acquisition activity. There's been a significant amount of that consolidation and merger in the last few years, and it's ramped up significantly since 2020. So, if we look at it within just the fund administration industry in Europe alone, I've seen about 50 since 2020, which is, a lot of consolidation. So, what's driving this? Well, I think, you're seeing, they're doing this for growth reasons, increase offering, reduction of costs, and staying competitive in a challenging marketplace seems to be the main reasons for that. But it's also a big trend. And then lastly, but not least, is the increased regulation and regulatory scrutiny we've seen from regulators across Europe and indeed beyond. So, because of that, it's very important for us to have an open, transparent relationship with our regulator, the Central Bank of Ireland. So yeah, I think and those are the key trends, Delphine, I'm seeing in Ireland, certainly.
Okay. And what about in Luxembourg?
Yeah, Delphine, and I would like also to mirror here what Joe just mentioned. So starting at the back, so we see also a heavy trend on the need for being compliant with regulatory requirements. So the ease of the obligations you have to fulfill for a fund management company, alternative investment fund manager, as well as also for regulated funds, is constantly increasing. On the investment strategy side, it's a clear trend, in my opinion, towards private equity, real estate, and debt. Beside that, and combined with the new requirements out of ESG, so sustainability, we see also there a lot on infrastructure, renewable energies as a trend for alternative investment funds. Beside that, as known in Luxembourg, we are a hub for distribution. The distribution for funds into EU and non-EU countries out of Luxembourg is constantly increasing. And here also the regulatory requirements are unfortunately also increasing in this respect. Further trend, we just briefly mentioned it in the other question. What are the, let's say, the structures or the fund types we can offer in Luxembourg due to a new regulation on the LTIF side, European Long-Term Investment Fund. I think here we will see an upcoming trend for launch of more of these products, which gives also more possibility for individual investors with certain amounts to be invested in, to be distributed also in EU countries.
Okay. And the next question for the two Joes. AIFM Directive 10 has been around for more than 10 years. Has it been successful in Ireland and in Luxembourg? And why don't we start with Joe?
Yeah, sure. So I think, like before, I mean, it's a difficult question to answer. I think the answer is yes overall, obviously, but I think it's probably worth looking into why it came into force and how it came into force in the first place. It came into force in the back of the global financial crisis. Certain events such as the collapse of Lehman Brothers and the Madoff incident highlighted the range of risks to investors in alternative investment funds and private funds were exposed to. So the EU introduced all these safeguards to ensure that investors in these funds were, well informed and adequately protected to allow, to avoid these, avoid the fallout from these events going forward. So, I mean, we're sort of 10 years on from the implementation of AFMD. And I think, as I said, I think it has been a success. I think you could just point to the increase in assets under management across Europe in that time. And as mentioned previously, there's now $7.5 trillion or euros worth of assets under the AFMD regime. So I think that would be a big indicator that it has been a success. Why has it been a success? I think it's probably been successful for a number of reasons. I think it's, you've got that increased investor protection, higher level protection being imposed on the managers on behalf of the investors. You've the harmonization of regulation across Europe, so even playing field, a single market for alternative investment funds. You've a lot more transparency. So, the AFMs are, obliged to disclose more, managers that are disclose more information about their funds. That helps the investors make more informed decisions. You've improved risk management as a result of it, mitigating more of the risks. You've enhanced market stability as well because of it. So I think, it's a combination of those that have it as a success. I think in addition, it's worth also mentioning that it is a globally recognized product now, so it has a brand recognition. It's not unlike UCITS, the more regulated retail version of it. So there is a perception out there that it is a highly regulated product with advanced investor protection. So overall, I'm saying yes, it has been a success.
All right. And what about in Lux?
Yeah, Delphine, I would agree with Joe. AFMD was and is a success in Luxembourg, and this has different reasons. As said already before, Luxembourg is one of the largest fund domicile in Europe, and it's also leading the cross-border fund distribution. So currently we have more than 75 countries around the globe where Lux domiciled funds are distributed to. Luxembourg, and also in collaboration with the regulator, whereas Luxembourg is known for having a very open and transparent communication with the regulator. The regulator is always approachable, which is also in the benefit for the investors, for initiator of funds, as well as for participants in the market. We have adopted in Luxembourg a very pragmatic and business-oriented approach for implementation of the AFMD in 2013, which then led to the implementation and giving the framework for the Reserved Alternative Investment Fund. So alongside with the AFMD implementation, one part of the success story in Luxembourg is really the Reserved Alternative Investment Fund. Whereas this product is per se not regulated, the AFM is regulated, but the product is still participating and benefiting from all the pros of a regulated fund. For example, also the marketing passport, as well as the cross-border distribution. Also, the time to market to set up a fund in Luxembourg is very key for initiators of funds. So here, it's really a known track record in Luxembourg that you're able to set up a fund within a few weeks only.
Okay. So one more question for you two. So how can a non-EU manager, someone from the US or maybe someone from APAC, access the European market? And Johannes, why don't we stay with you?
Okay, yeah, happy to take this question. So first of all, you would have two options. Either you are entering the market and you create your own AFM, whereas you administer your funds then within your own company. This being said, the process is very lengthy to get all the approvals, as we have heard also from Joe. The regulatory requirements and the regulatory burden is quite high. I have to fulfill a lot of reporting and substance requirements. So this would take an US manager, US initiator a long time, up to 1 year, even sometimes more. The other alternative is you appoint a third-party fund management company, third-party AFM, that fulfills already all the requirements, and let then the manager in the US or the advisor, the initiator, concentrate on their key expertise, which is investment, portfolio management, and making the respective decisions.
Okay. And Joe, your thoughts?
Yeah, I mean, just like Callus said, that they're the main options. For if you're going for a full AIFMD model, there is another option as well. Through a through so-called depository light regime, where you don't actually have to establish a fund, in a European domicile. So, under the national private placement regime, also known as depository light regime, you can, if you want to avoid going through the more substantial requirements of setting up an A for the European jurisdiction, you can, for instance, set up a fund in a jurisdiction like Cayman Islands or BVI or these types of, or indeed Delaware, where you don't have to go through all that. You do obviously have to appoint an AFM and a depository, but it's often seen as kind of an easier and cost-effective way of marketing into Europe without setting up on the ground. So I think that has also been a success story, where we have, I think, somewhere north of $1 trillion in non-EU AIFs marketed under that over the past several years. So I'll just give you a quick example. I think the fact that we had a client there last year who, by their own admission, had never heard of AFMD, prior to launching the fund, and they had the fund launched with ourselves as depository and a third-party AIF within 3 months. So it can be done quite quickly and without too much expense. But yeah, just conscious of time. So I think that's really I think between myself and Joe, we've covered most of the options there for US managers trying to access the EU market.
Okay. All right, so we're close to our quitting time. And let me just at least get 1 or 2 questions then from what's coming thus far. Question, from start to finish, how long does it take to set up a typical PE fund in Luxembourg and or Ireland? So Joe, if you could take that one.
Yeah, it depends really. It depends on, it depends on a number of factors. It could be anywhere between, 3 to 6 months, really, in reality. I think it also depends how fractured your service provider model would be. If you're appointing, numerous service providers, you've got to, negotiate several different contracts with different providers. You have due diligence to do on different providers. So I think, these are the factors that will, would determine the length of time. I think the one advantage that Intertrust has is that we have, most of those service providers that you require under AFMD under one roof. But yeah, in Ireland, I've given a kind of a long enough range, but somewhere in between, 3 to 6 months, I guess.
Okay, and in Luxembourg?
Yeah, I think it's similar. It's really depending. If you would like to launch a regulated fund, then you have to run through the full approval process from the regulator. So it might take a bit longer. If you go for an unregulated fund, for example, a RIFE or a standalone alternative investment fund, the period is shorter. As Joe already outlined, it's very important that you go then for a one-stop shop solution to reduce the time to market as well. And then we could end up for an unregulated vehicle with a standard setup between 3 to 6 months.
And we're at time. I would like to thank everyone for attending the webinar today. Enjoy the rest of your day.